Happy New Year, everyone, and welcome to First Command's quarterly update, where each episode we delve into the important market and economic issues of the day. I'm your host, Matt Connor, and I'm joined as always by our Deputy CIO, Matt Wiley, and Head Investment Strategist, Dan Murphy. Today, we're going to present our investment outlook for 2026, which, as of this recording on January 7th, is already off to a pretty dramatic start. But on that note, we are not going to be delving too much into the Venezuela developments. We just released our monthly market musings, which covers the topic in which you can grab from our social media accounts or your advisor. Instead, we want to zoom out a bit and discuss what we see as the major themes for the rest of the year. But before we dive in, let's set the stage with a quick review of the year we just left. Mr. Wiley, take us through the highlights of 2025 and bring us up to date.
Yeah, thanks, Matt. Well, suffice to say, 2025 was pretty unique, and quite frankly, the overall strong returns that we saw for the S&P 500 don't really tell the whole story. For example, 2025 was actually the first year in quite some time, it feels like, that the whole story wasn't just about U.S. stocks. In fact, the S&P 500 was up about 16% or so in change in 2025, and in most years, just about anybody would be pretty thrilled with that return. But quietly, international stocks were actually up a lot more, as in about 30% for both the developed and emerging markets. So I don't think anyone is really calling for that type of divergence ahead of 2025, given the Goldilocks situation or environment that everybody expected from both a U.S. and economic and profit perspective. And that really reiterates our philosophical approach to global diversification. You just can't call every winner every individual year. But of course, 2025 was not without its own drama along the way. They often say markets don't go up in a straight line, and that was certainly the case that we experienced last year. It does seem like ages ago, but 2025 didn't exactly start out real smoothly. So I'm sure most of you'll recall the volatility that was in place as President Trump's new administration agenda were being installed, and that was really punctuated by a V-shaped bear market and recovery that happened all within just a matter of weeks, and it was really a historic amount of volatility we had to work through. But once again, patience and focused on the big picture was really rewarded as investors ultimately focused on what was important. And again, that was the really strong profit landscape that was being led particularly by large cap tech companies and the artificial intelligence theme. You know, we also had the Federal Reserve come in later in the year and resume a rate cutting cycle after pausing for close to a year. And then you had the fiscal side really supporting the market as well. Both businesses and consumers received quite a boost from the One Big Beautiful Bill, and that's likely to keep paying dividends over the next few quarters. In any event, some of these same themes, I'm sure we're going to talk about a few of them, are already bleeding into market trends as we head into 2026. And of course, we've already kicked off this new year with some fireworks in South America, as you just noted, Mr. Connor. So with that in mind, I guess let's maybe go ahead and start pivoting in that direction.
Agreed, we should do that. But before we launch into that, we should provide a forecast backdrop, some framing, if you will, to drive home the fact that forecasts are, one, conditional, and two, shocks are always looming. As Matt just discussed, 2025 was a bit of a doozy. And while we would very much like to say that 2026 will be tamer, it's not likely to be the case. If last year flipped the script on geopolitical and economic norms, 2026 is the year where we start to see what that really means for the institutions, the countries involved. And while, the potential for shocks to the U.S. remain, we've got Fed independence debates going on, you got fiscal spending issues, AI is always looming. Dan's going to talk about that quite a bit. The true uncertainty may still lie elsewhere. We have a global landscape fraught with risk, persistent trade disruptions, regardless of what the Supreme Court decides, maybe even this week or pretty soon, if not, competing U.S., China, Russia interests coming to a head in Latin America and elsewhere. All that to say, this year will likely be anything but dull. With those caveats out of the way, we can dive into our forecast. Mr. Murphy, let's start with the U.S. economy. We've had some robust performance up to this point, despite all the hiccups we've been talking about and that we saw last year. So where do we go from here?
Terrific. Thanks, Matt. So if we step back and look at where the economy is right now, I think the picture heading into 2026 is pretty encouraging. After a year that felt uneven and at times fragile, the economy looks positioned for steadier and more broadly shared growth. In 2025, the economy managed to push forward despite some real headwinds. So spending by higher income households stayed strong, and investment tied to artificial intelligence absolutely exploded. And those two forces did a lot of the heavy lifting. At the same time, though, there were some serious cracks in the economy. Lower income consumers were under pressure, federal spending contracted, business investment outside of AI was pretty lackluster. The encouraging part to me is that several of those weaker areas now have potential catalysts behind them. If these come through, growth in 2026 should be less concentrated and more evenly spread across the economy. So let's break this down to the major pieces that make up the U.S. economy: consumers, business spending, government spending, and trade. The consumer accounts for more than 2/3 of total economic activity in the U.S. and historically is the biggest driver of economic growth. So let's start there. On the surface, this segment of the economy was remarkably resilient last year, even with all the tariff noise and higher prices. But under that headline strength, we're seeing a clear divide. Higher income households benefited from faster wage growth and rising asset prices, while lower income households felt squeezed by things like elevated interest rates, renewed collections on student loan defaults, and higher everyday costs. This last point is really important because the same inflation feels very different depending on where you sit on the income ladder. This is because as you move down the income spectrum, households spend more on essentials, and these have been experiencing higher inflation than non-essentials. There's also a more structural issue at play in the consumer sector. Employment growth has slowed. With less immigration and an aging population, the labor force just isn't growing the way it used to. That doesn't mean a recession is coming, but it does cap how much job growth alone can drive spending. Despite these issues, there are reasons to think 2026 could be a really solid year for consumers. One is tax relief from the One Big Beautiful Bill Act. Larger than usual tax refunds should start to show up early this year, and history tells us that households tend to spend a good portion of those refunds. There's also the political calendar. With midterm elections approaching, the odds of additional stimulus rise. President Trump has already floated the idea of using tariff revenue to fund dividend-style checks. And with Republican congressional majorities looking less secure, it wouldn't be surprising to see more efforts aimed at keeping the economy humming. Interest rates matter too. If policy rates move a little lower as we expect, the biggest relief should be felt by lower and middle-income households that rely more on variable rate credit. Even modest declines in credit card or auto loan rates can free up cash flow month to month. Finally, real income should continue to rise. To me, the labor market looks reasonably balanced. Firms certainly aren't hiring aggressively. We've all seen some of these headlines, but the layoff rate is also pretty subdued. This pretty evenly matched supply and demand picture tends to support steady wage gains. And if tariff-related price pressures fade, purchasing power could get an additional boost. So the outlook for the consumer looks pretty good. That's the first and most important piece of the economy. But let's also take a look at business spending. 2025 was a year of extremes in which a relatively small group of technology companies, we all know the names, Amazon, Meta, Google, Microsoft, they spend enormous sums on data centers and advanced computing. AI-related investment accounted for more than half of GDP growth in the early part of the year. But outside of AI, many firms hit pause, scared off by tariff uncertainty and rising costs. In 2026, investment should become healthier and more balanced. Technology will still attract massive amounts of capital, that seems pretty certain, but the pace of growth is likely to cool after last year's surge. Meanwhile, conditions are improving for non-AI investment. Tax incentives in the One Big Beautiful Bill, easing tariff uncertainty, financial deregulation, and more accommodative bank lending standards all point toward a broader pickup in capital spending. And smaller firms could finally start to regain their footing too. These businesses have been under pressure from high rates, higher input costs, and supply chain issues. But earnings are improving, which should allow these firms to expand capital budgets and play a bigger role this year. Okay, so that's business spending. Government spending is another area where the story should improve. In 2025, it was actually a drag on GDP as federal outlays declined due to efficiency efforts and a fourth quarter shutdown that delayed spending. State and local governments increased spending, but not enough to fully offset this weakness at the federal level. I think 2026 will look a lot different. The first quarter should benefit from spending that was postponed during the shutdown. Most of the major program and staffing cuts that we saw last year appear to be behind us. Defense spending on priorities such as nuclear modernization, shipbuilding, munitions restocking, these things should provide a steady baseline for federal outlays. Meanwhile, state and local governments should also spend a bit more, supported by tax revenues and rising property values. All told, government spending likely shifts from a drag in 2025 to a small tailwind in 2026. Okay, so the final piece of the puzzle is trade, which, if we're lucky, should fade into the background in 2026. Early last year showed how volatile trade can be when businesses rush to buy imports ahead of tariff changes, only to slam on the brakes a couple months later. That whiplash really distorted domestic economic activity. This year, tensions with China still remain, but the U.S. appears to have reached a new equilibrium with most trading partners. Big policy shocks seem less likely, meaning trade should be a much smaller source of volatility this year. So if we put all these pieces together, the picture for 2026 is one of steadier, more evenly distributed growth. Consumers benefit from some tax relief, potentially easier rates, and rising real incomes. Business investment broadens beyond AI. And with DOGE behind us, government spending turns modestly supportive, and trade seems likely to stop being a source of major volatility. So this is our baseline scenario, but there's always risks, and one of the biggest is inflation. So Matt, maybe you can talk to us about what you're seeing on this front.
Stubbornness, mostly, Dan. It certainly seems like the last leg of the Fed's journey back to its 2% inflation target is proven more difficult than many expected, with both CPI and the Fed's favorite PCE metric sitting far above it. And while we often caution against splicing and dicing inflation data too much, mostly because it's used to tell a particular narrative as opposed to useful insight, we think the headline and core numbers that dominate headlines do hide a bit of nuance right now, and that the inflation story is better told by looking at three key segments. The first one's going to be durable goods. Like you just said, tariffs were clearly the story of 2025. And these goods, think autos, electronics, furniture, that were most exposed, saw a massive price surge as the trade war developed. And while, again, as you said, overall trade levels may have peaked, how much of that amount that is passed through to the consumer may continue to fluctuate as firms adjust to this new normal of higher tariffs. Meaning that, while tariffs are often considered, we've said this many times, a one-time price shock, their effect on the consumer could linger a bit. But obviously overall inflation was more modest last year, mostly because of our second key segment, shelter, which heavily offset the rising cost of all those tariff-impacted goods. And shelter appears on track to continue its disinflationary trend, even though it may be slowing slightly. But while these two factors have been balancing themselves out, there is a third and much stickier component, which is core services, or services outside of energy and shelter. And this metric is perhaps the most useful when it comes to forecasting because it tends to be highly persistent. And it's also the component of CPI and PCE that is most correlated with perhaps, at least in my view, the most important inflation metric out there, which is wage growth. And with the accommodative fiscal shifts you guys have already talked about, and the expected Fed easing we're likely to see, this could actually become a bit of a problem going forward. Which is why our inflation outlook is slightly above consensus. But it all comes down to the Fed, right? And setting the mandate aside for a second, The real Fed story is obviously the ongoing White House pressure to cut rates and essentially fall in line with what President Trump wants to see on the interest rate front. In just a few months, we get a new Fed chair. While we do not know who's going to fill that seat quite yet, the market reaction around the various headlines and announcements thus far reads like market concern around Fed independence, with the obvious fear, at least in the headlines, that Trump's Fed will pursue accommodative policy, whether it's prudent or not. But I'll say this narrative isn't holding a lot of water for us for a couple of reasons. One, it's not showing up in the data that truly matters, which is inflation expectations. These have been well anchored while all the rabble-rousing's been going on. More importantly, we have to remember the Fed chair is one vote among 12. Yes, the chair has influence, but if there's one great takeaway from the recent Fed meetings, is there's a lot of dissent, which you want to see, one, when the macro backdrop is as muddled as it is right now, but it also gives us a lot of confidence there's not a lot of group think at the FOMC level. And the biggest one, perhaps, is whoever gets the role, no matter how Team Trump they are and how dovish their sentiment, is not going to be unaware of the risks of cutting too aggressively when inflation is, as we've discussed, still on the table. Like higher long-term rates as inflation expectations climb, like we saw in 2024. And President Trump wants lower rates, not just lower Fed rates. So, economic fundamentals don't just go out the window with a new Fed chair. That said, I mentioned it before, we do still see the Fed cutting rates, but we only see one, mostly as a nod to what the market has already priced in, and that slight dovish tilt we're already seeing, meaning the FOMC is just weighing the labor side of the mandate a little more than the inflation side these days. More than that, though, simply doesn't seem likely given our assessment of the improving labor dynamics that Dan discussed. And as a reminder, that doesn't mean we don't get that accommodative policy shift that we just talked about in terms of consumer support and business support. Stable rates in an improving economy are theoretically as accommodative as lower rates in a weaker one, and we just expect the former to be the way this plays out. So, which is also why our outlook for longer term yields, like the 10-year and the closely aligned mortgage rates, is kind of a sideways move. The Fed cut obviously drags down the front end a little bit of these yields, but given our more hawkish outlook on Fed policy, sticky but not really worsening inflation and stable growth, it's fair to expect the 10-year to finish mostly unchanged at the end of 2026. Which takes us to our final and perhaps most anticipated for those watching stock market. Dan, take us through some of the key drivers for stocks this year.
Thanks, Matt. So we hit on this earlier, but we're really coming off a strong year for stocks in 2025. And it was really a global story, right? So 2023, 2024 were largely about the U.S., but in 2025, emerging markets and international developed markets really got in on the action too, which is great and really speaks to the importance of diversification. As we look ahead to 2026, the backdrop for markets still looks pretty good. We're entering the year with a steady to lower policy rate environment, as you just discussed, and an economy that continues to expand. That combination really matters. So historically, stable or declining interest rates tend to support stock valuations, while economic growth lifts corporate earnings. When those two forces line up, equities usually have the wind at their back. So to put some numbers behind this, since 1970, U.S. stocks have average returns of about 20% in years when monetary policy is steady or accommodative and the economy is neither in recession nor just coming out of a recession. So that's sort of what we expect in terms of the economic environment. So those years have averaged 20%. That compares to roughly a 12% average for all years of the same period. So if our forecasts for rates and economic growth are in the right neighborhood, the macroeconomic setup looks pretty favorable. Importantly, the story in 2026, as I said, it's not just about U.S. large cap stocks anymore. Earnings growth is really broadened meaningfully after the profits recession we saw in 2023. Across regions and market segments, corporate profits have re-accelerated, and that supported a much wider set of equity market gains in 2025 than we had seen in prior years. And emerging markets are a good example. So like the S&P 500, they've benefited from a sharp rebound in corporate profits. Large technology companies in Asia have really led the charge, but they've been supported by strong results from other segments of the global market, like precious metals producers in South Africa and banks in India. Those earnings gains helped really drive outsized equity returns in 2025, as stronger balance sheets and expanding margins helped revive investor interest in the space. Looking ahead, solid economic growth across many emerging economies, combined with favorable financial conditions and resilient domestic demand, should help sustain healthy earnings growth and support equity market momentum into 2026. Developed international markets tell a more mixed story, in my opinion. Earnings growth there has lagged the U.S. and emerging markets, reflecting less exposure to fast-growing technology companies and softer domestic economic conditions. Even so, these markets managed to outperform the S&P 500 in 2025, helped along by optimism around potential fiscal changes in Europe, hopes for renewed growth under new leadership in Japan, and a weaker U.S. dollar. The challenge for 2026 is that many of those tailwinds are unlikely to repeat. With only moderate earnings growth and somewhat more restrictive monetary policy than the U.S., developed international equities may find it hard to keep pace this year. Finally, there's the small and mid-cap story in the U.S. Profits for these companies have been slower to recover, weighed down by elevated post-pandemic input costs and the added burden of higher tariffs. But still, earnings growth turned positive in 2025, and the easing margin pressure in 2026 should allow that momentum to build. As the earnings gap between large companies and their smaller peers narrows, we would also expect returns to narrow, suggesting that leadership in the U.S. market could become more evenly distributed. So stepping back, the outlook for 2026 is one of cautious optimism. The macro environment is supportive, earnings growth is broadening, and while not every market segment will shine equally, the overall setup remains favorable for equities. It won't be a straight line higher. Markets never make it that easy, but the fundamental forces behind stocks appear to be pulling in the right direction. So that's it for me. Any final thoughts from you, Matt, before we wrap up?
Thanks, Dan. That was all fantastic. I will just add that if anyone wants to delve even further into our 2026 outlook, we will be releasing the full report around mid-month on the First Command website, so keep an eye out. And also be sure to follow us on socials. And obviously subscribe to this channel so you never miss a release. And with that, we thank you for joining us, and we'll see you next time.